Hey everyone, this is Eugene, and something like 1 week passed, and I'm here today to talk about three things. First of all, fundamental things we see on the market. Second one, it's about the S&P technical analysis, and the third one is about FAANG stock. Fundamental stuff. What is important? Here, the crucial moment is the fact that for me, capitalism is dead. And what it means, in fact, in the capital environment, on the capital markets, you basically let the market decide who is weak and who is strong. You let the strong survive and you let the weak die. That's quite a standard principle, or you can call it a natural selection, and that's what basically capitalism is. However, this is not what we have today. Today, Jerome Powell and the Fed organization in the US, they are new superheroes, and the whole organization can be compared with the SHIELD organization, which you see in the Marvel movies. They want to manipulate the natural selection principle in order to replace some parts of the chain in the whole value chain that is delivered on the market before the market. They have what's so-called SPV, which is a special purpose vehicle, and the main purpose of that mechanism is basically to save the municipalities in general. So for instance, you have a city which needs some kind of help, and then they create that kind of mechanism in order to help the organization. However, what we see today, they use exactly the same principle to save the companies, to save in some sort of the people, and as I explained in a previous video, the junk bonds. So how they do it? If I need to explain that thing in a very simple words, in fact, Fed decides what kind of support they will give. Let's say it's going to be a support for some US corporations that needs that support. And basically they give the guarantee to the banks that any debt that they will take away from those US corporations, they will cover. So one principle they have is that usually they cover 95%, and the other 5% are staying still in the books of the bank. Why they do it? Because they at least want to prevent the schemes and some sort of the manipulations by the banks, so they will actually do some validations from whom they are buying those debts. Otherwise, they might end up in a junk bonds. Why they do it? They don't want collapse to happen simultaneously at the same time in many areas, in many sectors. As I mentioned, they don't want the whole chain to be blocked. And so what they want just to drag it all over the long period. They also want to reassure you and me. Why? Because first of all, they basically print money and they push it on the market. And they also want us to put our own money, because the moment we feel reassured, we actually take our money and we put it on the market. And by doing that, we let the market continue the way it's working, and let's say the normal principle of how market operates. And there is a small problem, which is a ticking mechanism that is on the market. Let's call it a bomb mechanism. And right now, this kind of support that they have, it's basically a delay that you have on top of that bomb. And then they actually can say 5 minutes and 10 minutes, like in the movies. That's what you see. Well, everything could be fine, and let's think about infinity money that somebody will give it to us for whatever reason. But there is a simple problem. The problem is that some companies that are part of that value chain in which whatever market you could have, they are not efficient. So, for example, they are spending more than they could get, right? So some of the companies, they have a very long-term debt that they were not able to restructurize. However, because the market was booming and everything was fine, they still had some chances, and they were able to restructure the debt and again and again and again. So what they do today is, in fact, they give the money to the company that potentially the normal company does not deserve that. So if you cannot generate more revenues, but you increase your debt and your costs, you should not take more money and more debt, because you just create the gap bigger. And that's what they are exactly doing. So you basically have to give that companies a possibility to simply die. I could compare this thing to the COVID situation. You really need to think about it just like this. So you remember this kind of publications where they say flat the curve or something like that? That's exactly what they are doing it right now. So with flat the curve, they are trying to make sure that the whole hospitals are not over-occupied at the same time. They also don't want to do the same with the companies. They just don't want those companies to die at the same time. They just drag it, right? And we also know the destiny of those unfortunate people, that 80% of people that are on events in the New York and everywhere, they are unfortunately dying. So we know that those companies that are getting those temporary debts, they are also going to die, and majority is going to be more, maybe even more than 80%. Of course, strong will survive. We have some examples from the oil industry, then we have retail today, and we also just got the news about the bankruptcy of Hertz company, which is more than 100-year-old company. So it's really like that. That's what we see today, and we will see more. Before we go to the technical analysis of the S&P 500, here is the summary for the fundamental part. There are a lot of companies that are fundamentally not sexy at all, and those companies will have to die, and they will die sooner or later. Another point is that guys like Warren Buffett, that are basically long-term investors that are sitting really on a huge pile of cash, they did not use that opportunity. So for already like 2 months we are in this crisis situation, but we see that Warren Buffett didn't put his money. He actually injected more cash into his accounts, on his accounts. And what it means? It means that right now there are no opportunities. From that point of view, it means you better sit on a cash rather than you try to buy something. Why? Because there is not that normal situation. Fed is actually playing a role of the Warren Buffett right now, because in a normal situation, companies that are quite okay, like it was in 2008, when the Goldman Sachs came to Warren Buffett, they got 5 billion from them. So because the company was quite okay, there was no substantial problem with that, and so they got money, and Warren Buffett as investor saw the opportunity that is a value, and he was able to put that and allocate quite some money, and then in a couple of years gain the profit. What opportunities we do have today is basically to speculate within a day. So you could really have a fast runs, but you need to be very careful. Sometimes I do that. It's not really what I like. But if I see some really good opportunities on a day, I will do that. Not as a professional day trader, but still the market mechanics are quite similar, and then you just need to respect the speed. Another important part is that Fed may be the only organization that could allow that. Why? Because they are printing dollar. And you cannot do that with the other currencies. So if you will think about, I don't know, the Japanese yen, this is something which is not really possible in their economy. There will be huge inflation. But a lot of investors in the world, they basically don't have alternatives. They don't have, first of all, so many instruments on the market, and they don't have the substitution. So if you think about Swiss franc, for example, what's the economy? It's just like this. There's nothing more. So that's the reason why Fed is actually leveraging that situation, and yeah, they could do that. So this disproportion between the rich countries and poor countries is going to be even more and more and more.
Now let's see the technical part of S&P 500 and FAANG stocks. So I put those two together just to save a little bit of time. So in short, you see the levels, which is the red one is the resistance and the green one is a support, nothing special. So you also see the powers. So right now we're still in a very trendy zone, let's say this way. So overall the market is basically not in a V shape anymore, because V shape would have been something like that, while right now we're in a swoosh or some sort of the Nike type of the recovery. So the next resistance is this 3027. That's the interesting one. So will we bounce from that one, or we're gonna slice it as a butter? I don't know, we will see. I'm still bearish, and I keep 75% of my cash and only 25% in stocks. All this growth that we see here is, in fact, you see, is as a separate zones. So you never know up front, you don't have a picture, you cannot put it correctly into perspective. So every day is basically, or every week is breaking what was in before, and you don't have a predictable trend. So that's why there are not a lot of options for the midterm investors like myself. Now, if we go to the S&P 500 1-hour chart, you can see it over here. There is an important point about divergence. So what is it? So in fact, you see that there is a specific parameter, the specific technical indicator, that is a very well known MACD. And normally what it does, it shows you the trend. If it's below the zero, it's in a negative zone, and if it's above the zero, it's in a positive zone. So, and other thing is that normally the spikes of the indicator and the price chart has to follow the same trend line. So you can see that over here and over here, we're basically in a flattish, a little bit growing mode. And then when correction started, both indicators and the price, of course, went down. There is a very steep growth over here, and that represents the dead cat bounce. And while anyway, let's just follow the line. So somewhere up till this moment, this indicator and the price were aligned. Then it started to break. While the price was still going down, indicator was rapidly going up, and then the price turned the different direction and it started to grow like this. While indicator stopped somewhere in the beginning of the growth of the real price and started to go down. And this is actually what divergence is. If you take this word, divergence is this. So when the indicator is going to the south and when the price is going to the north, it can go the opposite direction as well. So it's also going to be divergence, but the opposite one. So here it's the signal for the correction. So normally the price should go down. Of course, it's not the exact science. So it's even if it happens, it doesn't mean that this is exactly the sign. And right now you already have to make a correction, but that's an additional thing that you need into the bearish basket, and keep that if you really want to have proofs on the fact that correction is waiting somewhere around the corner. Now, another point that is important, if you don't know what is VIX, VIX is basically a fear indicator. So when there is panic on the market, people start to drop their stocks and they start to buy put options and all these kind of other instruments, and they create this kind of huge spikes like we see today. So you see that almost all the spike is gone already. However, what is very interesting, we are still in a zone of 30, and zone of 30 is in fact the almost maximum that we had in the correction of 2018, when the market went down quite significantly as well. So here we're still in a way when the companies and other buyers on the market, they still buy a lot of put options, and put options is basically the insurance that give you a right to sell a stock at a specific price if something happens. Of course, you can use it or you may not use it. So in case if everything is fine and you don't need it, you will not use it. But people are fearful and they are buying put options. That's a fact. And with this type of VIX indicator, it's clear that we can easily return to this zone, which is still super high. Of course, I just mentioned all those beautiful things and I didn't open the Pandora box for you. And for some people, maybe you found something interesting, but quite some people already know about that stuff. They check it, and of course, professional investors, they do know that, and it's not a secret for them. I'm quite like this girl. The emotions are like that, And yeah, I see the Fed support that they are trying to push to the market, don't fight the Fed. Then, of course, Donald Trump is saying a lot of beautiful words that we're skyrocketing and so on and so on. So, but we also do understand the phony and or fake nature of that, and we know, as from the fundamental part, that some companies are gonna die. We just don't know which one of those, right? So this question is still there. Taking that into account, we put our decisions quite in a specific way. And how we do that? Let me explain now. So these are basically the options. So for the option number one, which is day trade, so over here, of course you could, I mean, first of all, not everybody can allow that. Then not everybody knows how to do it correct. And some people like myself just don't like it, right? I don't like to do that kind of things. So for those guys, what is very, very interesting, they actually don't even care if there is a crisis or anything else. It's very good for them because the moment they have volatility, they have opportunity to make money. And I know I follow a few channels and some people, they really do a lot of money right now. So yeah, but that's not the option for everybody. Another option, which is much more typical for the retail investors, is to go for the blue chips, or what's so-called FAANG stocks, representing the logos that you see there below. And these options is basically driven by the fact I want to buy something for sure that is not gonna die. Like for sure this is not gonna be the bankrupt like with Hertz or anything else. This company is gonna be doing great, right? And it's a very solid and big company. That's the typical options. There are two investors types. So the previously I was talking about the day traders and the crowd. So basically it's the retail investors over here. Of course, day traders, they are a bit more professional or much more professional, and there are institutional investors. So what's the difference? So the institutional guys, so like this guy, they are basically looking like a day trader, but the day trader can wear a t-shirt and this guy has to wear a suit. So, and on top of that, he has to go to the office 9 to 6. But the question is that what they have to do. So this guy with Coca-Cola can over here, and a couple of beautiful charts there, he has to build the position. So if the fund decides that they are going to enter Amazon, they are not going to enter Amazon for 30K or 100K. They're going to do it for 30 million or 100 million, and they have to buy it for a specific price. So maybe they will buy it from 1.8 to 1.9. And his actions are going to be the opposite way. And his actions are going to be to make some specific manipulations or tactics to get to the position of Amazon for that amount of money. While day traders are in general, they are just trying to catch a swing, very fast one on a 5-minute chart, 1-minute chart, depending on the situation, get their profit and close the deal by the end of the day to make sure that they don't have risks like of gaps opening down and so on and so on. And they always, of course, use the leverage to make their profit even higher. However, for these guys on the right side, so the crowd, the situation is different. So they, first of all, they don't really know a lot of things. So I'm pretty sure that all those guys, they know what is Amazon, let's put it this way, but who knows out of those guys what is the company FAANG or I don't know, even Twilio. This is not the typical suspects for them, right? So majority will always go for Amazon. And what is even worse is that the other 70% of the guy, they will not even do any stock picking. So 70% of guys, they are gonna go just for the index passive fund. So like, I'm gonna buy the market and this is okay for me. I'm not gonna do anything more. So that's the typical behavior. And what do we have in the end of the day? Is this. So here you see the three lines. The line in the middle The candlestick pattern, the candlestick chart is showing you the S&P 500. The yellow line is the line that represents the bank ETF, KVE, and the black line is the Nasdaq or QQQ ticker. So it's very, very clear. We have two things over here. So thing number one, and then I will tell you what is thing number two. Thing number one is very visible. So you see this drama difference between the performance, 4% over here, comparing to this point 1 year ago, and what we have with the banks. Banks are minus 33%. Actually, can do it this way, comparing to S&P 500. And Nasdaq, that is basically representing the tech stocks. So S&P 500 is usually the broad index, which covers the different companies, oil and blah, blah, blah. And here Nasdaq is more technical ones. So Nasdaq is even plus 27%. I see, I like this option of showing the things, comparing to S&P 500, and of course, taking into account what I just mentioned a few minutes ago, that it's already waiting for the correction, that Nasdaq is waiting for correction even more. Now, coming back to the second point I wanted to say is that you see the spread. So the usual regular spread is somewhere in this kind of zones. In the beginning of the crisis, we see that the spread increased dramatically, then it shrinked, so we were falling quite the same way, and then on the recovery phase, the spread became enormous. What I'm trying to say is that right now we are not in the normal situation. How long will it take? Nobody really knows. But what is really true is that it will at some point it will come back to the stage number 3, to the normality. So we will come back to the situation like we have here with the spread. So it's either we will go this way, these lines will come together, or they will go over here, or they will go over there. So somebody will follow somebody. But something tells me that actually we're gonna go closer to the maybe yellow line, to this zone, or somewhere there. Here is what we have. We have a huge overpower within the index of those companies. I also see Microsoft over here, and it's not part of FAANG. I'm very sorry for that, but of course it's one of the other companies that is extremely popular. So here you see the difference. So the moment I'm saying that the crowd or somebody from institutional investors, nobody, I mean, it doesn't really matter. They have all the different reasons why they buy it. So in the institutional investors for the liquidity, because if they want to buy 30 million, yeah, they can do it with Amazon and other companies. With some small caps, they can't do it. We ended up in a situation that these companies are overpowering the indexes. So at one hand, 70% of guys are buying the passive index fund itself, and they inject money de facto into the Microsoft, Apple, Amazon, Facebook, Alphabet. And the cherry pickers are also doing that because they are looking for the liquidity, or they are looking for the possibility to find the blue chip, and they just want to put it over there. So if somebody will start to buy right now those 5 only stocks, the whole index will go up or the whole index will go down. And here is the chart. Here are the charts that we have. So I didn't put which one is there. I put Facebook, V-shape, even more than V-shape recovery. Then we have Amazon, super V-shape, and then the standard V-shape for Apple, and then almost V-shape with Google. So the message, buy Google. No, don't buy Google. If you look at this situation, it feels like these companies have just launched 10,000 people or 10 million people to Mars, Venus, and all the other planets. They made it natural habitants for us, and they of course managed to sell the advertisement, YouTube advertisement, to those 10 billion aliens that we met as well somewhere there, and their performance is so great. Of course, all the other universes are buying iPhones and so on and so on. No, it's not the case, right? So nothing has changed. It's just 2 months or 3 months that passed. These companies didn't do something extraordinary. They are exactly the same in the end of the day, maybe a little bit better or a little bit worse. With these problems that we have in the real economy, where 35 million people lost their job, where we have situation that people are not able to pay for the mortgages, or they are not paying for the rent. I mean, they are not gonna buy the iPhones more. They are not gonna pay for 3 subscriptions here and there. So taking that into account, the if the profits of those companies are gonna stay at the same level as it was before, that would be really great. But something tells me that it's not gonna be a case. They might have some short-term effect. Thanks for them. I cannot say thanks because it's not a good word. Thanks to these situations that we have. But overall, nothing has changed. And correction is there to come, right? So here or here, maybe it's going to be here and not over here. We don't know. So it's going to be somewhere over there. But the moment it will happen, it will drag the index down, and then this domino effect or chicken and the egg effect will continue to impact the market. It makes no sense for them to be so damn expensive. That's actually everything I wanted to say. I will continue sharing my overviews, and make sure you put your like, comment, subscribe. Thanks for watching.